This question mentions his rental properties, right?
Mm-hmm.
That was how I got my father to early retirement, was I had him put money in cash flow banking. That's a great place to save your money, very safe, very secure. And then as he found properties to purchase, he was able to just take the money from his life insurance, buy the property, use the cash from the property to pay the policy back, and then rinse and repeat.
Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Are you too old to set up a cash flow bank? My kids think I am. What happens to cash value insurance if you start later in the game? Is it worth it? Too expensive? And is there anything you can do to improve the performance? Also, what are the best ways to pass on money tax-free? Stova, what's our question today?
We have a great question, and I'm excited about it because this question is going to help a lot of people move forward powerfully in their life. And I think that's what I love about these episodes with you guys, is because of the knowledge that we're sharing, people can get clarity around their finances.
I thought you loved when we made you laugh, or I thought you loved when we destroyed your beliefs around money. So
both usually happen every time we're recording
cool.
episodes, so I'm kind of used to it by now. Okay, so today's question, you guys ready? This person says, I'm fascinated by your books and love the family banking concept. My question is, at 60 years old, what would be the best way to set up that type of system? I plan on working a couple more years and don't have a lot of cash, but do have a 401k plus a pension plan as well as some rental properties and plan to buy more. At my age, does it make sense to start a whole life policy, or is there an alternative way to accomplish passing on a legacy?
Well, Timmy, let's turn it to you.
Okay.
I know you got some numbers pulled up so we can look at actual numbers for someone who's older.
Yes.
I think it's A, how they fund it.
Yep.
B, what their intention is. If you're retiring tomorrow, probably not the best idea.
Yeah.
We have a couple years, and you got rental properties, and this can be a good way to acquire rental properties. So maybe you can explain cash flow banking and show us an illustration.
Yeah. So it also depends too on how long you're able to fund it for. So are you gonna transfer other assets into it? Because he mentioned he's only going to work for a couple more years. If he's going to work for a couple more years, it could be hard.
Well, we can overfund for 3 years without, with $100,000 from the 401k, depending on the rules and regulations of his employer.
Yep.
Without the 10% penalty. But I guess he's 60, so there's no 10% penalty anyway.
Yeah.
So I don't even know what the hell I'm talking about. So I'll turn to you.
Okay.
Next, money nerd.
So I ran an illustration on a 60-year-old man, and I did it as max overfunded for 7 years. 7 years is kind of one of the minimum periods we can overfund.
So this is a cash value policy.
Yep.
Right? What locks in the gains once it happens. So it's whole life, a specific type that you can put what's called paid up additions. And so that's what you mean.
Yes. So on this policy, you can see we've got it on the screen for you guys. I just ran this at $2,000 a month for the overfunding period, and then dropped it down to the minimum premium only for that point forward. And you can also cancel that completely if you want to at that point. So the first year you'd put $24,000 in, you're going to lose some because you bought a permanent life insurance policy. So you're going to have $17,700 in cash at the end of that first year.
Right. So savings account beats it. 401k beats it.
A shoebox.
Shoebox.
Unless you die.
Most everything.
Yeah, because it comes along with about $400,000 of death benefit in that first year, even for a 60-year-old.
Right. So they have to have an amount in reserve as part of this, and obviously they're paying commissions.
Yeah, they're going to pay commission,
marketing fees,
medical underwriting, marketing,
all that kind of stuff.
Reserves required by the federal government, those things. Well, that's what the rest of that $24,000 went towards.
Yep.
Second year, their balance will be about $38,000. So they went up about $21,000 out of their $24,000 payment. So still these first 2 years, you're not in a great position. If you're going to stop from there, you're not going to win. Yeah, don't do it. Right. Now, the third year, you grow a little bit better. Now you actually had a $24,000 a year growth. Right. So in the third year, you went to $61,000 out of their $24,000 payment. You're still going to be behind overall by a few $1,000. Right. So it's going to take until that fourth year. Probably closer to the fifth year till you've broken even from those first couple years of loss.
Mm-hmm.
Along for the ride was a death benefit. So by the fifth year, you would have had $114,000 in cash now. You'd have about $541,000 in death benefit. And so that's kind of how the policy is going to work. At the seventh year is when I cut off the funding. You'll have $172,000 in cash, $612,000 of death benefit. So you'll see that death benefit's growing from $400,000 as well.
Right, and a lot of people think, I don't want to die to get a benefit, and I agree with that. So we'll put across the screen where they can pick up What Would Billionaires Do, my book that talks about how you can use a death benefit in 6 different ways to create cash flow from stagnant, non-performing assets like equity in real estate. Or there's ways that he might be able to sell that real estate tax-free because a death benefit exists, and that could boost that cash flow 20 to 50% because of the tax advantages. So there are benefits to that death benefit, even though we're really looking at the cash value. So if you're not going to do this for at least 5 years, I'd say 7 years is probably your best case scenario.
Yep.
And then even then, if you never want to put another dollar in, you can do something called a reduced paid up policy. It will lower your death benefit, but you will have no cost assessed against the cash value, and it will grow based upon the guaranteed cash value plus any dividend if that applies, which we only want to look at companies that have always paid a dividend for 100 years or more.
Yes. So you've got a very secure savings account is what you've got. An extremely secure, way overperforming what the banks will do on a savings account. Great thing to fund investments from out of this account. This is what I used model for my father and a bunch of other clients now to fund their investments. So he mentioned this client, or this question mentions his rental properties, right? Mm-hmm. That was how I got my father to early retirement, was I had him put money in cash flow banking. That's a great place to save your money, very safe, very secure. And then as he found properties to purchase, he was able to just take the money from his life insurance, buy the property, use the cash from the property to pay the policy back, and then rinse and repeat.
Look, and one of the considerations could be after a certain number of years, if he stops working, start transferring the 401k over into the cash value over time. Not all at once, not triggering all the tax, but doing it over time so it's in a more favorable position when you really require stability. There's something called disinvesting when someone is now taking money out. Investing is we're putting money in, we're looking for growth. Disinvesting is we want to start taking cash flow from our investments, and unfortunately, there's an overemphasis on net worth, so people end up saving, investing, and now it's time to create cash flow in those retirement years, but they're not trained to do it. So a volatile account where the market's going down, if you take money out, it kills that account too quickly. So if you can create that stability where you have a guaranteed interest rate or a dividend that can come in, and by the way, that dividend is going to come back to you tax-free first because something called FIFO, first dollars in or the first dollars out. So they give you your principal before they give you your interest. Plus, if you borrow, which isn't with your credit score, it's against the cash that's in the policy, that's tax-free, and it only has to be paid back upon death from your death benefit. So this could be a very effective way to do it, but I would say 5-year minimum, 7-year preferred.
Yeah.
Funding.
Anything less than that is going to put the policy at risk, and it wouldn't probably be worth doing.
All right. So look, that was pretty straightforward. We'll let you know what to do. All right. This is Garrett Gunderson. You can now turn your thoughts into profits, build the life you love, and go to AskTheMoneyNerds.com. Ask us some questions. I'll bring Timmy. Let Stolba tell some jokes. Be an advocate for the listeners and maybe have a good time and help you out along the way.